Good afternoon, everyone. Welcome to COVID-19 Relief in 2021, What Small Businesses Need to Know. My name is Nicole Atala. I'm a partner with Polaro Mazza, PLC. And before I go any further, I'm not going to forget the good old disclaimer, which is we're going to be talking about a lot of things today. And this is not legal advice. It's not accounting advice. We don't know your specific factual situations. What we want to accomplish here today is to have a good discussion about how relief has changed from 2020 to 2021, what you can be looking for in 2021, and certainly encourage your questions. But you know, this is not the best forum to look at every specific factual scenario, so we have to give you that disclaimer. I'll let everybody introduce themselves, but again, my name is Nicole. I'm the chair of the Labor and Employment Practice Group at Polaro Mazza, and I'm happy to be here. Sai, I'll hand it over to you.
Yeah, hey, I'm Sai Alba. I'm a partner with Polaro Mazza in our government contracts group. We've just been really in the weeds on a lot of these COVID issues and upcoming things, so happy to kind of be here and talk through the questions we've already gotten from clients and things, hopefully, to help everybody out.
Hi, I'm Blaine Klesky. Hi, thanks. Blaine Klesky, principal of Harkin Advisors. Small consultancy providing strategic operational financial advisory services, and have been going through CARES Act and first draw and second draw since the very beginning with some of these fine folks on the phone here, as a matter of fact.
Thank you. And I'm Catherine Hickey. I'm the chair of the Business and Transactions Practice Group at Polaro Mazza. So I work very closely with Sai and Nicole, and also with Blaine, on advising clients on many of these issues related to the CARES Act. My focus is often specifically in the context of change in control transactions and other M&A transactions, and so we can touch on that as we work through what small businesses need to know today.
All right. Let's go to the next slide. I can, there we go. Thanks. So we're going to, these are broad categories for discussion. And what we really wanted to let everybody know is that we encourage questions. And so please feel free to send in your questions as they come to you. But to get us started, Blaine, what do you see as, you know, the big ticket items in your world in the second round of relief?
Yeah, I think in the differences in the program, I think a lot of folks know it's 300 people, not 500, or according to NAICS codes. It's a 25% revenue reduction, but I think it's important to note that there are some vagaries having gone through this process now with a couple different businesses. For the second draw specifically, there are vagaries and some gotchas that I think you might want to look out for. I would say, first of all, read your lender's documentation requirements before beginning that PPP loan application. I can think of one institution, TD Bank, that has a 68-page step-by-step guide. It's actually pretty quick to go through, but if you don't go through it, you find that you might miss certain things that they need. At a very high level, remember, lenders have different application data ingestion capabilities and functionalities. And as this group was just talking about before the rest of you got on, you know, these banks that you're working with are really the lenders and adjusters and adjudicators for this. So while sometimes things don't necessarily match perfectly to the interim final rule, it's really their call. I would say a couple of the big uglies, and then I'll kind of turn it over to my colleagues, you will note that next to the payroll cost calculation fields on this new form, it asks for number of employees. That has not been clearly defined in the interim final ruling. So specifically, you are able to use the 2019 payroll costs that you used on your first draw. And if you recall, the number of employees was a factor in your forgiveness. They have been silent, that is the Treasury and SBA has been silent on whether or not that's a factor in forgiveness, leading one to draw the possible but not confirmed conclusion that that the number of employees may just be what they're using to determine your eligibility now based on the 300 employee factor, or hurdle. So you may very well find yourself in a situation where you have a 2019 payroll cost, but you're putting the current number of employees. And I expect we will see that in some frequently asked questions or guidance that comes out second. And the only other point I would bring up is that there are 4 additional fields next to your intended usage. And they do not rope you into necessarily using for those purposes, such as operational expenditures, but it is wise to check off anything that you think you may even possibly want to use it for. So there are no questions down the line. They are simple check boxes. And then finally, if you are applying for your second draw, and you are using the payroll costs that you used in the first draw, I have recommended that you use the same source documentation. If you use 944s, use the same 944s or 941s. And if you do use differing documentation, it is incredibly advised, or strongly advised, that you ensure that those numbers do tick and tie, because that will be a red flag if not. And I'm going to kind of leave it. I'll leave it there. I'll give you some more as we go on.
Sai or Catherine, do you guys have any commonly asked questions about, what's new? What should I be watching for?
I can jump in with just a couple points to make with respect to the second round and things to consider. In particular for borrowers who already got a first round loan. So as most people are aware, I think there's this requirement that you have experienced a 25% revenue dip for a quarter in order to be eligible for the second round loan. And there is, as Blaine mentioned, the threshold for size eligibility is down to 300 employees as opposed to 500 for the first round. And with respect to that size threshold, it's important to note that you need to go through the analysis to determine your eligibility based on size, brand new for this second round loan. Don't just assume that because you were small under the first one, or because maybe you already knew based on your analysis under the first application that you had fewer than 300 employees. You do need to take a look at the numbers again. You need to see how that may have changed. And in particular, you also need to look and see how any affiliation ties may have changed if you have undergone any transactions between your first application and your new application that resulted in changes in ownership specifically. You need to redo that whole SBA affiliation analysis and trace through and make sure that there aren't any new control issues or new commonalities of ownership that may put you out of that size, even if your own, the actual employees of the borrower might be sub 300. So don't just assume that you can kind of check that off the list simply because you qualified under the first one, because it does need to be kind of reevaluated as of the date of this new application.
To that point too, I've also heard some folks ask questions, some of the like private equity or venture capital, that they made an investment, say, I don't know, June or something, May, I don't know, sometime after the first round, right? They acquired a company. That company now would qualify because it has losses of more than 25% in any given quarter. But in one case, they had done a tack on, right, in November, I think it was. So they acquired a company in November for a few $1 million, and they were thinking about closing on a second one in March or April of 2021. The need analysis and the need certification applies anew when you ask for your second draw. So I think people who are like in that kind of situation or something similar, where you're showing the government that you have all these funds to buy companies, I think it's a real problem to make a need certification in late January that you need a few $1 million up to, $2 million is the max, up to $2 million whenever you just spent $3 million to buy a company in November, and you're spending another, $3 million because you have this line of credit that was created for various acquisitions or something like that. So just be aware that just having the 25% loss in one particular quarter doesn't necessarily get you all the way home. There's other things you have to worry about. And then to the point that Blaine made about the employees, I think the best analysis is probably just using SBA's calculation, but it's not entirely clear. So if you're assuming that you're using SBA's calculation, the 1 year still applies. The 2-year change was enacted in the 2021 NDAA, which actually came a couple days after the Economic Aid Act, which created this program. So it arguably doesn't apply. And in addition to that, it doesn't go into effect for another year. So still use the 1 year, and it's over the 12 months prior to the application. Whenever your application goes in, is probably the best way to do your 300 employee analysis. So just sort of be aware of that. And it takes into account all of your affiliates, but the same affiliation exceptions that applied in the first go around apply here as well, with a couple more for NAIC 72, which is like restaurants, hotels, certain media organizations. So if you're in a kind of different category than your traditional government contractor or whatever, you should probably check on some of that stuff as well to make sure you qualify.
Yeah, so just to follow up on that, there are a couple of gotchas in this that I think we should be aware of. The IFR interim final ruling clarifies that the borrower must have spent the full amount of the first draw on eligible expenses under PPP rules as a condition of eligibility, which is a direct quote, for the second draw. So borrowers, particularly those of you who have not sought forgiveness, which I'm going to guess is a good number of you, need to be certain that your uses of the first draw funds do qualify as eligible. Otherwise, that could become a problem for both your first draw forgiveness and technically the eligibility of the second draw. And in tandem with that, I would say that when you are completing that application, something I have run into in the last few days is if you are seeking a loan of less than $150,000, you'll note that it says you do not need to show the substantiation for the quarterly revenue reduction. Yet the 2483 SD application does show you a field or ask for a field. What is your revenue reduction? If you complete that revenue reduction field, the bank will expect that you will submit, at the time you submit that application, the substantiation. Point being, if you're seeking a loan for less than $150,000, you may wish to leave that blank if you are not going to provide the information now. And I have seen an application for less than $150,000 be kicked back because the substantiation was not included.
What about, we have a question about independent contractors, and I haven't seen this particular case, but whether you all have had any experience with whether a company can exclude revenue going to independent contractors to count towards their 25% reduction in income. I haven't, to me, revenue is revenue, and you have to count what goes to independent contractors when you're doing that calculation, but wanted to see if you all had any other insights on that.
I know the IFR came forward and said, look, the law, the Economic Aid Act, didn't define gross revenues. So SBA stepped in and said, we're going to use our definition under 13 CFR 121-104, not 104A, which is just the pure definition, but the entirety of 104. So you have to take into account revenue of affiliates, unless you have an exception, when determining the 25%. So it has to essentially be across all of your companies combined, all of your affiliates. This, though, this question is talking about 1099. So you paid 1099s. The revenue, the gross revenue under 121-104 is whatever your your total receipts plus cost of goods sold, or including costs of goods sold, is on your tax return. So that wouldn't come off at that level.
Right.
So you would include all of the amounts that you paid to whomever. It doesn't matter if they're 1099. It's your
That's right.
total gross revenues.
But keep in mind, I think, from the SBA's perspective, and there is a certain amount of logic here, it's not necessarily intended in that way to be disadvantageous to companies that have a high amount of 1099 revenue that's passed through, because it's supposed to be an apples to apples comparison of your business in 2019 versus your business for the same time period in 2020. So the idea being that if that's your business model, it should be an accurate representation. If you include that revenue for both of those measurements, the amount of decrease should be an accurate representation of the general impact to your business of the COVID-19 crisis.
What's interesting too.
Sorry, go ahead, Sai.
Oh no, sorry. If you look at the definition of 121.104.2, it does exclude certain things for certain companies. And I haven't come across this yet with any particular client, but it's interesting that if you're excluding like pass-through costs for people who do like travel agents or things like that that are specifically enumerated, that those amounts come out entirely from your analysis. And I don't know if that would be positive or negative for folks. So that's important to pay attention to, but it's only those specifically enumerated industries, like which is not many people.
Yeah. Was there any update? We have a question about how forgiveness, moving on to a little bit of forgiveness, but how forgiveness will be treated for tax purposes.
Yeah, that's been taken care of. So yeah. The forgiveness amount is not included in your taxes. It's also not included for purposes of your 25% reduction. What has come up in a question is, what about other grants or special funding that companies got that is not PPP forgiveness? Would that be included in the 25% reduction? And there's actually nothing in the law or the guidance right now that's clear on that. So what I've been telling people is that, and I'm curious if everyone agrees, that because you're using the SBA rule under 121.104, that if SBA would not count it for purposes of your revenue, if you're doing your size calculation, then arguably it doesn't count for the 25% rule. So if your accountants or whoever can say, well, this is a particular source of revenue that would not be in your cost of goods sold or your total receipts lines on the tax return, then arguably it's not included. But I haven't seen a particular example of that yet. I'm waiting for a couple of people's accountants to get back to me.
What about, just as long as we're kind of on forgiveness, loan forgiveness generally, I know we've started to see companies start to apply for forgiveness, trying to fill out this SBA form 3509, questions about, should I wait? How long should I wait to apply for forgiveness? Just generally, what have you all been seeing as far as hurdles or challenges in applying for forgiveness?
Why don't I just start real quickly, just to clarify, the 3509, for those of you just questioning that, that is for folks with generally over $2 million loans, where there was questions about the application, the usage, et cetera. The forgiveness applications themselves fall into three buckets: the 3508, 3508EZ, and the 3508S. 3508S is for borrowers who took out loans of less than $50,000. The EZ is for borrowers who did not reduce employee levels, wages, or hours, and the 3508 is the full shebang, if you will. I guess Sai's probably in the best position to talk a little bit about the 3509 since he's had some pleasant experience with that.
Mm-hmm.
Yeah, we've been working through a number of 3509 forms, which, if you look at the form, it asks you mostly information about what happened to you after you took the loan. which is arguably irrelevant to the analysis of whether or not your initial certification was made in good faith. And SBA actually did get sued over that. And there was like a quick quasi settlement. The AGC, the Association of General Contractors, sued them. And there was a settlement where SBA basically said, no, we understand that it looks like that it looks like we're using irrelevant information, but that's not how we're actually going to use it. We're asking you all these questions about what happened during the covered period. Did you take out money? Did you have lines of credit? Did you lose money? All of that stuff. Not to necessarily make a determination on its face as to whether or not you were eligible, but to give us information to see who we should look at more carefully. And what the SBIG told me when I talked to them about this is that they're putting applications in buckets based upon what comes back on the 3509. That only applies over 2 million if your loan was over 2 million. But for those individuals, you're getting in a, oh my gosh, these guys got clobbered, just forgive them bucket. There's another bucket on the other side, which is, this is really questionable. We should probably forward to DOJ and let them handle it under civil fraud or possibly criminal. And then most of the people, 95% or more, are going to be in the middle, where there's going to be some level of scrutiny given to them. And I've seen one case so far where SBA has submitted supplemental questions to the 3509, giving the borrower a second chance, is I think how they categorized it, to like prove their need, and ask them for even more information that's irrelevant, like their Q3 and Q4 revenues and financial information from Q3 and Q4 of 2020, which again is completely irrelevant. So in that particular response, we were a little bit more aggressive in basically telling SBA it nicely that the stuff you're asking about isn't really relevant, but here's all the information that is relevant, and this is why we took the loan, because at the time it was the outlook was so dire for us in our industry. So just make sure you're focusing on that stuff. If you have a 3509, focus on what was happening to you, not just, and I'll say, don't just state, oh, the businesses were shut down so we couldn't have in-person meetings. Okay, who cares? What does that actually mean for you? You couldn't have in-person meetings, so, and you might think in your industry it's obvious, right? But you need to spell it out for SBA in those sort of 1,000-character sections of the form, what impact it actually had on you. And I also said to be hyperbolic, right? Make sure if you're including information, if you lost, the example I use, if you lost $10 and you were expecting $20, don't say you lost $10. That sounds lame. Say your losses, or you lost 50% of your expected revenues. Like that sounds more dramatic. Like use things like that. Use your language to the most effective way possible.
Yeah, just to reiterate Sai's point, but obviously everything that you submit in response to any of these forms needs to be true, accurate, and complete. But you should view this as a piece of self-advocacy, because this form is going to be used to vet and sort and identify what applications for loan forgiveness may be worthy of additional scrutiny. And so to the extent your business has actually been impacted negatively, use this form to make that case. It will require more time to complete these responses, especially within the character limitations. It's going to need to be carefully crafted, but you should really try to use the information that's requested to put together your best case for why your company was negatively impacted by the crisis, and why, even in hindsight, the loan proceeds were necessary. And the best way to do that is to, any chance you have to provide those additional explanations, fill those out. Don't just submit the factual data and call it a day and move on, because that you may be missing an opportunity there to really make your case.
Mm-hmm.
There's a bunch of questions that just came in. Maybe I could just combine them all quickly into an answer, because I think a bunch of them are closely related. One question was, hey, 35OS, my banker told me to hold off on that until February because the banks are inundated with second draw. True. In fact, some institutions have actually said, we're not going to do forgiveness now. It's usually the same processing pool of people that they're using. Additionally, my personal view, and I think that of my colleagues, might be that we have seen the guidance has generally been helpful to and accretive to the value of forgiveness or the flexibility of forgiveness to the borrower to wait. They have not made it more stringent. With regard to the question that was asked, hey, do I have to use everything before the second draw? The answer is yes. It's before the disbursement of the second draw. You need to make certain that you have dispersed and used those funds on eligible expenses. I think the specific question was, hey, what if it's after December 31st? You have a covered period or an alternative covered period, depending on whether your loan was dispersed prior to June 5th, 2020. And you have 10 months from the end of that covered or alternative covered period, respectively, to go ahead and seek that forgiveness. As far as the question about, hey, government contractors and forgiveness, and I know it applies to a subset of you, so I'll be brief and anybody can reach out to me afterwards. Government contractors are a bit of a different ball of wax when it comes to forgiveness. The government contractors, you can't double dip. If you have direct and indirect expenses that are paid for by a government contract, to the extent that the PPP funds would cover those same expenses, that is not okay. So you have to be within the letter, spirit, and intent, not only of CARES Act, Economic Aid Act, PPP, but also your government contracts, and specifically the FARs that do not allow double dipping. That said, so what are your options? You've taken PPP, now what? Well, I'll give you a bifurcated answer. For those of you who have taken PPP, I would say that you have an option on one end is, hey, take it as a loan, do not seek forgiveness. And on the other end, you can go through and determine to what extent were those PPP funds used for internal research and development expenses that were not otherwise paid for by a government contract. And the second part of that bifurcated answer is, for the second draw, it is incredibly important, if you wish to have 100% forgiveness, that you establish a strategy up front on how you intend to use those funds. So, for example, if you're an R&D firm and not a production, and do not have production contracts where you have to keep those wheels turning, you may want to go to your KO, your contract officer, and ask to extend. If you're coming up against the end of the POP, you can say, hey, can we extend the POP, no cost extension? And during that period right after disbursement, you can strategically use those funds on things that are not being paid for by your government contracts. So I'll leave it there because I know it only affects a subset of you, but hopefully that's helpful to whoever asked those questions.
I'll say too, though, that I think my interpretation is that if you just have government, you're just a government contractor, that's how you make your money. That in and of itself is not double dipping. It would be, but DCAA, if you get audited or they look at it, they could require you to, under FAR 31, there's a refund clause, right, for certain things if there was a cost analysis performed. So if you had a cost reimbursable contract, they should have done a cost analysis. If you had a firm sole source, they should have done a cost analysis. And if that went into place, then those amounts or those contracts, they might ask you to give a refund or reimbursement to the government based on the PPP and give a credit to them. Also, if you took 3610 funding, which is the government paying you for being shut down when you're not actually working, that is across the board with OMB, DOD, basically every agency has said if those exact dollars went to pay the same dollar went to the same expense for PPP and 3610, then you're going to owe the government a credit if you get PPP forgiveness of 100% of that dollar. But I think if you're just doing work, I think you could get forgiveness, has been the way I've sort of read it and talked to some of the accountants.
What about the differences between kind of the first and second draw? And if you didn't take all you could have taken under, in 2020, you decided to take a smaller amount than you could have taken. what's your advice to companies at this point in time? Should they go back and try to, make that up, or should they just be looking forward to a second draw?
I mean, I have heard a couple banks, I've heard one bank that basically said, we're going to let you pick. We're not going to give both a second draw and allow you to supplement your first draw. That's not in the law, just to be clear. The law allows for both. But I think to Blaine's point earlier, the banks are really in control of this. That being said, you can go to your original, to supplement your first draw, you have to go to the same bank. But to get a second draw, you can go to a different bank. So that's always an option. Might not be ideal because the first bank probably knows you and has all the information. And if they're going to allow you to do both, it's probably better to do that, and you can do it simultaneously. But if you needed more, you can go through the same process. If you have additional amounts that you would have been eligible for now, you can do that. Or in theory, if you gave money back, you can go back and reapply for the first draw.
Right, and I do think that that's important to highlight in case it wasn't clear, that for the second PPP loan, you are permitted to go with a different lender. Throughout this process, we've worked with multiple clients, and unfortunately, some lenders have been incredibly difficult in the process and in communications with clients, and how quickly they move, in how adaptable they are to unique circumstances that might apply to a particular situation. So if you are one of those companies that experienced headaches with your original PPP lender, you are not necessarily wedded to them if you decide to go for a second round loan.
Yeah, I would agree with that. And I would just add that if you did have a good experience with your lender, there are certain efficiencies to be gained. When you log into certain systems, they already have your loan amount, and they can facilitate. It's really a preference based on your own experiences.
If you had funds left over, sorry, go ahead, Si, finish your thought.
No, there was a question here on people who, for the 25% or things, if your 2019 was just a bad year, for having nothing to do with anything, right? It just circumstances were such that you had a really bad year. So your 2020 was better in comparison, but still not so hot. But because you didn't have that 2019 to 2020 loss of 25%, can you plead your case saying, hey, I had a really bad year in 2019? Unfortunately, SBA, I don't think they have the discretion to do that. It's in the law. So unless Congress amends the law, SBA can't waiver from that. The joys of federalism.
Mm-hmm.
Yeah. And there are limited ways, right, for them to they got a lot of heat coming out of the flexibility in the first round. So I think that there is some desire to try to put some parameters that everyone can live with, even though there might be some outliers.
But connected to that though, for some businesses that had a lot of frustration in the first draw, they had just gone into business, they had just begun operations, and there really wasn't a whole lot to be done in the first draw. In the second draw, they have made provisions for that. Specifically, if you've started after 2Q or even 3Q, you can compare your 3Q and your 4Q of 19 to 3Q or 4Q respectively of 20. So they have thought about those that did go into business. I had one business that actually had just purchased the business in February of last year. Again, that was a special circumstance. They kept the DBA, and it was the same employees for a 40-year-old business, and we were able to successfully make the case to the lender, same address, same business, same DBA, same employees, and the lender said, okay, this meets the spirit and intent of what we're trying to do here.
That's a really interesting point, Blaine, just because anecdotally, we just had a similar question from a client that was technically a newly formed business in 2020, but it formed and it acquired via an asset acquisition all of the assets of a previously existing business. And so their question was, well, we have all the employees, we're using the same DBA, we have all the same customers, we assumed all their contracts. Can we claim that we're a continuation of that business and thus make our case for eligibility for a loan because we meet the financial metrics? And we looked into this to see if there was anything prohibiting that. We couldn't find anything in the law that expressly stated that they wouldn't be eligible. And if just based on general principles of it being a successor via the acquisition of substantially all of the assets, our advice was, go for it. Ultimately, to your point, the lenders are the gatekeepers there. And so if you can convince them, make your case, then, there should be no reason why under the law you're not eligible. So it's something where, hopefully you can work with your lender and make them understand why you should be able to do that comparison, even though, the actual name of the entity for 2019 may have been different, but it's a continuation of the same.
I think, and when you have these special circumstances, whether it's this case or another one, help them find Waldo, right? This is not a senior vice president of a bank adjudicating your loan and processing your loan. So it is really important that you let them follow the bouncing ball. Be very neat in your documentation. They now, a lot of the ingestion systems allow you to upload additional documentation. Put a cover letter. Explain, this is what I'm doing, where they can follow it, where if it's logical and intuitive, you stand a lot better chance. If they see different tax IDs on your corporation now, your payroll now, your 944 or 941s from last year, it's too difficult to follow, and they're doing too many of these. Without that roadmap at the very beginning, you don't stand as good a chance.
What if a mistake was made? There's a question about, and I don't know if you've seen these actual cases, but you got more on accident, or oops, there was a mistake made somewhere. What is the prevailing thought on? Do you just give it back? You call the bank? What should somebody do if they recognize that there's been an error somewhere?
Wasn't that the community chest or chance card in Monopoly? Bank error in your favor.
Exactly. Yeah.
Well, I'll give my non-legal perspective, and then I'll defer to the legal eagles here. I had one such case, and it was a de minimis amount. I mean, we're talking hundreds of dollars. So you could not seek forgiveness, or I think it was approved. If it's a de minimis amount and you used it on approved costs, I think if if the ATM gives you $100 more than is yours, it's really not yours. So, so I would be thoughtful and careful. I have also seen where you thought they gave you more than you deserved, but actually you submitted documentation to them where they said, oh, this person did not include, for example, the payroll taxes that were paid by the employer, or perhaps some of the other eligible costs, so they have added it in. So before you go and raise your hand and say you gave me too much, go through it again and make sure, because they probably had a reason to give you that.
Mm-hmm. That's a good point. But at the end of the day, if in fact you did receive more than you were eligible for, and it somehow slipped through both the lender and the SBA, I think the correct answer is, number one, definitely don't submit for forgiveness for that amount, especially if it's more than de minimis. And ideally, you would, promptly after noticing the error, you would contact your lender, inform them of the error, and then offer to attempt to repay the difference of what you were not eligible for, because technically, while yes, the loan was issued to you, upon audit there's always a chance that error could be identified. It's much better if you self-identify and fix it before the SBA is coming back to you and asking for the money back down the road.
Right, and on the Monopoly theme, the get out of jail free card does not work.
What? It's shocking to me.
You know,
I wanted to go over just, sorry, go ahead.
I was
So
gonna
you had
say,
a thought on this point just before I move on.
yeah, just one other thing. So if you had this scenario, right, where you gave something in, and especially if you're applying for the second draw loan, if anything comes up in their review of your first loan or your forgiveness, your second draw is held up. And so if you're submitting stuff for your second draw, my understanding is they're kind of comparing, and that can actually, if there's some question you had about your first draw, like don't get greedy. Because if if you were in the heat of the moment back in the day in April or something, trying to figure stuff out, and you made an analysis and said, okay, well, there's risk here, but I'm going to accept it. By now doing the second draw loan, that could open all of that up and give you additional scrutiny. So just be careful.
What do you guys think about choosing which? We had a question about what the appropriate form is. If I have less than a $50,000 loan, or how do I pick? If my bank says you can pick one of these three forms, pick your alphanumerical character behind 3508. What advice can you give folks on determining which form is appropriate?
S, easy, and then 08, right? So start with the S if you qualify, and the easy, then 3508, less is more. And there's also a question, hey, do you think that they'll raise the threshold to 150,000 with just automatic forgiveness? My answer to that would be don't count on it, and keep your ducks in a row.
Yeah. Sai, I think there's a little bit of confusion for some of our government contractors that are on the line about what we mean when we say you can't double dip. What are you talking about? And maybe this is the first time some of these folks have heard, wait a second, I might be double dipping. What are you talking about? So can you kind of reiterate your thought, and I think you and Blaine both touched on this, on what does it mean when somebody is double dipping on a government contract? It's not like they were using the employer tax credit and the PPP. It's a different concept, right?
I mean, and this is where I'm not, there might be disagreement. I think there's a lot of confusion about this, and I think there's varying levels of, I guess, conservative views versus more aggressive views. I've always taken the position that, look, you will potentially owe money back if you have, let's say you have a firm fixed price contract like this question, or T&M or firm fixed price, where it was sole sourced, right? The government had to do a cost analysis, or should have, before of that. And TINA, the Truth in Negotiations Act, or whatever it's called now, should have been triggered. So you should have given cost and pricing data to the contracting officer. Even if you didn't, that should have happened. And on those sorts of contracts, DCAA could audit you at some point in the future and say, look, for those amounts, or even a modification that added something to a contract or added a labor category that wasn't bid in the original competition, that's arguably a sole source modification for that labor category, let's say, a cost analysis should have been performed. So on those examples, the amount of like G&A and overhead and things like that that are attributable to that modification or that sole source contract or something like that, if you get forgiveness here, you will owe a credit back, or should owe a credit back to the government for what, and it's somewhat a complicated, right, accounting analysis of how much of that forgiveness gets attributed to which cost pool and bucket and over all of your contracts. But there'd be some amount of refund required. If you had cost plus fixed fee or cost plus award fee or something, cost plus contracts, and it's all your contracts, then arguably you'd have to pay a credit back to the government across all of those cost reimbursable contracts. So it's any contract where there was a cost analysis performed, especially cost reimbursable in particular. But I think if you're just working, say a firm fixed price contracts, everything was competitively bid, and you're just doing your work, I haven't considered just being paid by the government to be double dipping just by itself. Same thing with 3610 is another example of where if you got 3610 funding and PPP. But there, I think you could also, I'll say, play games, for lack of a better term, where if you really track the dollars carefully, you could say, well, these 10 employees were necessary and I got 3610 to pay them, but the PPP funds over in this account I used to pay not those 10 people or any of the costs associated with those 10 people. I just used it to pay the other 90 people in a 100-person organization. And I paid those 90 people with PPP funds, and you can track those dollars really carefully. In theory, you could say there was no double dipping because those dollars went there and these dollars went here. But I'm not sure if DCA is going to have the same interpretation at the end of the day.
Yeah, and I would agree with everything Sai said, and to just give it a real, practical example, for most government contractors, especially those who are on the, up the maturity curve, you have government-approved timekeeping systems. You have your allowable, your unallowable expenses. So a perfect example is it's something that's already being done for unallowable. You're doing fundraising, capital raising, and you're paying employees who are putting in that timekeeping system, capital raising. That's 100% forgivable. That's the government never gets charged for that, nor does that get allocated out anyway. And back to the example of, hey, if you have an IRAD, internal research and development code, and these folks are just doing stuff that's accretive to the value of your enterprise, you can track that separately, and a lot of your systems will have the ability to make that pretty clear. Just be mindful of the questions of this dialogue when you're going through the process, and that's why you have these great folks to call if you have any questions when you're going through it. So it's better than talking to the DCAA.
I haven't heard anything about the government or through legislation or otherwise attempting to quote unquote fix this problem to the extent it even is a problem from a government perspective, but curious to see if you'd heard anything about that.
No, in fact, the media, I think, is almost pushing the opposite. The media, I think, would love if government contractors, because they have couched, I know the Wall Street Journal really early on, and a couple other publications put out articles that, look, the government's paying these contractors to do their work and they're getting PPP. That's horrible. And so I think that's sort of the push from the public relations side is actually worse, not better. And so I don't think there's any desire, and especially DCAA, they literally make their money. They get paid by agencies, right, to do audits. So they exist because of the money they get back from contractors. So I don't think there's any impetus for them to walk that back. But I don't know, Blaine, if you have.
I totally agree. And let's face it, generally when you're speaking with the DCAA or the DCMA, it's in hindsight, right? They're coming in forensically to take a look at something. And they can be pretty thorough in that analysis and how deep they want to go. But again, an example going back to, again, I look at spirit, intent, and letter, and if the idea of PPP is fundamentally to keep people employed, and you're a smaller government contractor, for example, who would have had to let people go, and you say, you know what, I'm on the R&D side. I could extend my period of performance by 10 weeks at no cost, and my KO is okay with that. So I'll go ahead and do some IR&D. I'll pay for that with PPP funds. Then I'll go back to the government contract. As long as it's above board, your KO is okay with it. You really could think about it. You might have just doubled the length of time you have to keep that employee on board before having to let them go. To me, that sounds like it's a very defensible position to say, hey, is that not what this was all about?
Right. What about subcontractors? Are subcontractors impacted any differently, Sai or Catherine? Sorry, I keep going to Sai. Catherine, I'm not ignoring you, I promise.
No, he's the GovCon usually.
No, that's where the particulars of FAR 31, the flow downs in FAR 31 are required. So if you had to do a cost analysis for your subcontractors, and that goes also to this other question about does it apply to sole source awards not competed? That's an oversimplification. It's anytime there was a cost analysis performed, it triggers the applicability of FAR Part 31, which is all the cost section of the FAR. And if you're triggering FAR Part 31, then the credit section of FAR 31 also applies. So generally speaking, if you had a competed firm fixed price contract, there was probably no cost analysis performed. So you don't have to worry about it. But if there was a cost analysis performed and if it was sole sourced of any type, there should have been a cost analysis. So that's where there could be exposure. But if you have all firm fixed price contracts and all sole source because you're a new 8A or something like that, the chances of DCA or DCMA actually coming in and looking at you is slim to none. So while technically, if they did look at you in the next 6 years, they could go back and say, hey, you owe us a credit for this. They could do that. It's probably unlikely.
Yeah, look, the other thing is December 11th, 20, and somebody actually just pointed this out in the group here. DCA released an audit alert on the coronavirus legislation regulations, and it basically went to their regional directors and their corporate audit directors and assistant directors in HQ, and they said, hey, we're providing you guidance on the legislation regarding COVID CARES. And each contractor dealt with many, dealt with, you need to understand what is the impact for those unique circumstances. And during the planning phase of an audit, the auditor should discuss with the contractor which relief opportunities, if any, the contractor chose to employ. And the auditor should ask for any COVID-19 company policies and procedures, as well as any changes or exceptions to policies and procedures in effect before the pandemic. You can find this online, so I won't read it all to you, but what I would say is, again, there is latitude when they come in. I think they're looking for it to really make sense. If it smells right, it looks right, and it's within the spirit and intent, I think you stand a much better chance. I tend to be conservative on these things because it's always just a better approach, but be prepared, be organized. Keep your funds, I would say, seconded into a different account from PPP. The color of money is very important, particularly with government contracting, and make sure you keep the color of money consistent and well tracked.
Yeah, and we just received a question about the employee retention credit, and so very quickly, I want to just go over how the employee retention credit has changed. I don't know that, particularly with the employee retention credit, at least I haven't seen special considerations for government contractors. I think, again, you have to carefully look at whether you qualify for the retention credit to begin with. And some of the changes that I think are important to keep in mind is that, one, it's been extended through the first 2 quarters of the year. The amount that you can qualify for in order to get a credit for the wages that you paid to somebody have increased. So it used to be 50% of a credit up to $10,000, now it's 70%. So you can essentially get $7,000 for each of the first 2 quarters of the year, assuming you qualify. And in order to qualify, there are some changes to how you might qualify. They've lessened the burden, so to speak. So if you compare, again, we have to do a 2019 or 2020 to a 2021 or a 2019 to 2020 comparison to quarters. And you have to look at whether or not you had a dip in your gross receipts by 20% or more for the 2021 quarter. So that's one of the ways that you can become eligible. There are a number of different tweaks to it. One of the interesting tweaks, I think, because a lot of companies, I don't think, were looking at the employee retention credit because they were taking advantage of PPP. It used to be that you couldn't take advantage of both, right? They changed that. So you can take advantage of both. But here again, we get to that double dipping stuff, right? So you can take advantage of both. You can even go backwards and take advantage of both. But you have to make sure that you're not double dipping, which requires you to very carefully look at your accounting and making sure, I think we've said, and Blaine and Cy and Catherine have said kind of over and over and over again, have your ducks in a row, have a plan, know what you're doing, talk to your advisors. Don't just assume that everything is clear in your books, because when you get audited, that's really going to be the test. So as far as, special considerations for government contractors, I would say it's really the same considerations of everybody. Make sure that you understand how you experienced that reduction in gross receipts, or how you can demonstrate that you've really taken a substantial pause in your work for 2019, 2020. I don't know if anybody else has anything to add, but that would be my advice on the employee retention credit. And then as far as just really quick on FCRA, the Family First Coronavirus Response Act, this is, I think, the simpler of all the things we've talked about today. But there was a lot of talk about whether this is actually the first piece of coronavirus relief, which was passed very early in 2020 and provided 80 hours of sick leave for folks under special circumstances. And if you were taking care of children, you could get an extra 10 weeks of leave at a certain, cap and pay. There was questions about whether that would be extended. It was extended, but on a voluntary basis through the end of March of this year. So companies are not required to extend it, but they can choose to extend it. If you do choose to extend it, again, you are, and many companies are, because there is state legislation that in many states that also provides for some amount of leave. So it makes sense. It's 100% essentially tax credit that you can get for providing the leave. It doesn't provide 80 hours more of leave. So if somebody already took their 80 hours, they're not going to get another 80 hours. This is for people that you get 80 hours cumulative through the entire period from April 1st, 2020 through March 31st, 2021. But you're going to get paid for that. So that's good. But you also then, if you choose to extend it, are going to be subject to, having to be careful about retaliation, making sure that you can get people to show up to work and abiding by the rules. So if you decide to take it, you've got to play by the rules. So that's what I would say about that. Just trying to watch. We have 3 minutes left. With our 3 minutes, does everybody want to chime in on what you see on the horizon? I know there's been a lot of talk about a third massive or less massive round, depending on your feelings about bipartisan cooperation. But any advice about what you see on the horizon for 2021?
Yeah, I would say I think that it is fairly likely that there will be some extension, some additional aid. My prediction would be that the requirements to be eligible will continue to become more stringent and will be more specifically tied to specific negative impacts experienced by businesses. So while I do think that that's likely to continue, I think that the legislation will continue to be more and more tailored to those businesses that can demonstrate that they have suffered and are continuing to suffer.
Yeah, because that's my understanding, just from a few of the lobbyists that we work with, is that the people on the Hill, all the congressmen, senators, they've all been kicking themselves about the first way the first loan was done because of all the bad press and stuff in SBA and everybody. So I just don't see that sort of thing happening again. And also, remember, the need analysis is guaranteed to get carried through, if not get more stringent. But even the way it is now, I think there's a real question about whether there's economic uncertainty for your particular business, given what's already occurred. So if you're an airline or a restaurant or a hotel or something like that, certainly. A lot of the professional services stuff, not so much. It's been hard, right? It's going to be hard to make that analysis certification.
My crystal ball broke, so I don't get another one until December. So.
Yeah, and I mean, from a labor and employment perspective, I feel like we've been drinking out of a fire hose since the Biden administration started working. I expect that barrage of changes to continue into 2021. I know we had a few questions we weren't able to get to today about the new OSHA guidance, and there's a lot that's going to be happening with respect to minimum wage initiatives, unions, holding folks accountable for OSHA and related coronavirus response issues, which opens kind of a whole other ball of wax that we could probably talk about for a significant period of time. So we're just keeping our hands on the steering wheel, and we will keep you guys posted as new developments occur. Very, very happy that you all joined us today. I know that we are out of time, 3 o'clock, right on the nose. So as always, this is fun for us. We appreciate you guys spending your hour with us, and we'll certainly circle back if we didn't get to some of your questions.
Thank you.